Good afternoon, everyone. It is Monday, just afternoon, and it is time for our Monday market update. And there's Squitten, my little squeaky kitten in the corner, who's come to join us today. So today, July 17th, can you believe it? And honestly, it's the sun is shining. It's beautiful. I wish I was down at the ocean today. The ocean is absolutely stunning. But let's have a look at what's going on in the real estate market. And I'm just going to get my presentation up and let's get going. So I'm Jennifer Tim. I am the owner of the Welcome Home Global Group. We are a real estate team in Southern California, and we are passionate about helping you grow, protect, and transfer generational wealth across the globe through real estate. So let's have a look at what's happening in the national arena first, then we'll look at Southern California in general, and then at a couple of our cities in particular. A question that I've been asked most recently is, are we still in a seller's market? Folks are not really seeing too much real estate activity. They're so busy with summer and enjoying the beautiful weather that we have, but they're a little curious about what's going on. So let's have a look at this question from a national point of view. And of course, we do need to start out and look at the economy as a whole. So our quick market recap: consumer credit was much lower than expected in May at just 7.24 billion versus the 20.5 billion expected. Mortgage application submissions increased. So we'll just kind of summarize these. And the big news, the big report that came out is inflation on the consumer price index continued to cool in June and was below expectations across the board. And there's some more information about that. And of course, some information about jobless claims. The big thing with the consumer price index is this is what the feds are looking at. And this is basically what's influencing their decisions to then apply additional rate increases to the Fed rate. Again, this is not a direct increase to the mortgage rates. Mortgage rates respond to the 10-year Treasury, and the 10-year Treasury is responding to the Fed rates. So the news was good from a CPI point of view. So what did that do to us in our marketplace? First thing we're going to look at is our mortgage rates. So 52-week average mortgage rates has come from Mortgage News Daily, and this is sent to me by one of my lender partners actually in Texas. I am licensed in Texas as well as California. So our 30-year fixed rate current, and this was information that was sent this morning, sitting at 6.89%. We'll have a look at what a couple of our lenders here in Southern California are offering. But obviously that is a higher interest rate than what we have been used to over the past, I'd say, 5 years, where we went down as low as the mid twos. And of course, everybody wishes we would be back in there. Well, those were the very unusual days. As I mentioned to a group of business owners the other day, if we end up back in those low twos, it probably means that we've got some global pandemic crisis going on, and we certainly don't want to go back to that. So we are looking for interest rates to get a little lower, which will then bolster our real estate industry. But right now, this is where we're sitting. So we're just below the sevens, which is a good thing because we have had, if you look on the extreme right-hand side for our 30-year fixed, we have had, if you look at the 52-week average, we have had a high of 7.37. We've also had a low of 5.05. Would be great to get back to that rate, but that's not on the cards for any time too soon. How is this translated into what is actually happening? Well, this graph, I really, really like this one. So each one of these bars represents a week. So it gives us an idea of properties that are hitting the market and then how fast they're going into escrow. So basically an offer being accepted into them. So we have had this past week the most new contracts in 1 week in 2023, which was not expected. So that basically means that the buyers are out there, and when those properties are coming onto the market, they are purchasing the properties. They're seeing the value in owning real estate or owning that particular listing which is coming onto the market, despite the interest rates and in spite of the home prices, because the majority of buyers have adjusted to, where we are. They have looked at the affordability, and for the majority, this is something that makes sense for them as they grow wealth over time. Newly listed properties, our biggest challenge, and this you're going to see echoed in Southern California as well, is that we have such an inventory shortage. So we are this red line over here. So year over year, we are 25.7%. We've seen a decrease in the number of new listings. This is what's driving the real estate market of today. We have it's supply and demand. Do not have enough supply to meet the demand. As a result, those prices are going up. You're seeing multiple offers on the majority of properties, and buyers are definitely having to pay a little more than they thought they would in this market. Again, if we look, sort of looking at our averages over time, I mean, this is a big one as well. We're down 51% from 2019. Available single-family homes declined slightly last week to 465,000. So now remember, these properties, the ones that are coming on the market, are being found acceptable by buyers, and they're going into escrow within a week. So we're just not seeing anything staying out there long enough. And again, the story, and it'll continue to be this way until interest rates come down, is that we have so little inventory out there to meet the demand. One of the ways that you can increase supply, of course, is building new homes. And this is an interesting graph from Axios, which shows us the top 20 metro areas with the most number of building permits that have been issued per 10,000 people. And California, we don't come into the picture until Sacramento comes in at number 20. So that's another problem. We do not have enough new builds in Southern California to meet the needs. And as a result, we have many of our younger or our first-time home buyers who basically have to look out of state to get into the wealth building cycles of home ownership because of where our prices are. So also understand that when you see new builds here in Southern California, they do tend to start off in those much higher price points. And it's a function of where we are. It's a function of everyone wants to be near the coast. And then obviously the building expenses for contractors in our area is a lot higher. Share of luxury listings. So again, this ties into where we are with listing prices and property prices. So again, what are the top metro areas with the highest listing prices that are over $1 million? Of course, it's going to be LA, San Francisco, San Jose, and San Diego. And of course, Orange County, we're right here between the, in that mix. And then, of course, you've got percentage of listings above 5 million. And obviously, LA is right up there. San Diego is not doing too badly either. And we're in between LA and San Diego. So it just follows. And of course, because we have our beautiful ocean properties, I was absolutely so honored to be able to get in and view a $18 million property right on the ocean in South Laguna Beach last week, and absolutely stunning. You can walk out down the beautiful pathway and onto the beach, and it certainly is a very unique property and a unique experience. So check out my Facebook. I posted that last Wednesday when I do my Welcome Home Wednesday posts. Anyway, but just keep in mind, so this is we're going to explore luxury listings in Southern California a little more, but just understand that the majority of ours are in that luxury price point. They're above $1 million. And obviously the buyer pool is a little less at that price point. Median price of homes that are newly in contract, so new pending median, has gone up by 10,000 in 1 week. So we've got this little jump happening right over here. This is a national number. Forget about what I just said about Southern California. We're nowhere near that median price point. We'll have a look at our particular cities and see where we are. So this answers that question that we had last week, and then it lends itself to our are we still in a seller's market? The reheating of the market, of the prices, is widespread, with more than half of the 50 largest US markets seeing prices at or above 2022 peaks. So remember, the beginning of 2022, we had, it looked like we were just like the sky was the limit. Not great news for buyers, but certainly was great news for sellers. And then the Fed started applying, implementing those rate increases to the Fed rate, and the 10-year Treasury followed, and then the mortgage rates followed. And that's where we ended up, and I think it was October last year, with a 7.37% as the highest that we've reached. And that did definitely slowed things down. Higher price properties, we started seeing some price reductions. This is, we're back. So just 8 of the top 50 markets are currently more than 5% below their 2022 peaks. Firming prices have now fully erased the pullback we tracked through the last half of 2022. So that's what I'm talking about, that consumers are back, the buyers are back, and they have a need to buy. And the buyers who are out there aren't as impacted by the higher interest rates. And so they're back, they can build, they can buy, they can get back into the home ownership cycle. What is happening in Southern California? Well, as always, we're going to start out with our interest rates. And this was from a little earlier last week. I apologize, I did not see an update before I put this together this morning. But even though our jumbo 30-year fix, I always like to look at the 30-year fix because that's the majority of homeowners that have that loan package. So this one, annual percentage rate is going to be 6.23%. That's offered by one of our amazing local lenders from Wells Fargo. United American, they're sitting at the 6.5%. And then Movement Mortgage, they are, for the high balance, they're at 6.963%. So again, it's really important. Get your ducks in a row. If you're a buyer, make sure that you're finding the lender who has the loan packages that make the most sense to you. If you need an introduction, of course, we're always honored. You get to choose the lender. We do not choose the lender on your behalf. You need to make sure that they work well with you. We do have great lenders in the area, and we know they can get you to the closing table, which is always the goal. So our story in Southern California is all about the housing shortage. These reports that I'm sharing right now are from Stephen Thomas and Reports on Housing. If you would like a full report, we send it out through our newsletter every second week. But reach out. We'll put you on our newsletter distribution list, and you can get it that way. Other than that, we just put a couple highlights in there just to let you know what's going on. So right over here, these are done by quarters. As you can tell, if we compare to where we were in 2006, you can see how our inventory just has been going down and down and down. Of course, we've had various little peaks and valleys. But this is where we are right now. We really are in, very low levels of inventory, and and the buyers are still there, and we'll look at that. Our blue line over here shows where we are for our active inventory year over year, and we are definitely below 2021, way below 2022. And it looks like we're just going to maintain this low inventory environment. Expected market time year over year. So this is an indication of the speed of the market, and I'm actually going to do a separate little video that we're going to put out on social media to really kind of emphasize how much information you can glean from the expected market time. So that is defined, so it's the days on market from the minute that that property is publicly marketed to the minute that it goes into escrow. So there's an accepted negotiated offer, buyers and sellers are in agreement, they're going to move forward in escrow. And we do know, based on this chart up at the top, that if we're less than 60 days for that time period, it's a hot seller's market. And our 60 to 90 days is a slight seller's market, 90 to 120 days is a balanced market. I'm not even going to go anything beyond that because we just haven't been there in so long. I don't think anybody can truly remember a deep buyer's market in Southern California anymore. So we are sitting a little over the 40 days, but definitely below the 60. So we are still in a hot seller's market overall. Now we are going to look at luxury. Luxury is a little different. And yeah, when you look at the numbers of what's on the market, that kind of tells the story as well. But just know, Southern California, we are in a hot seller's market still. If you have a property which is priced according to its location and condition, you are going to get it in within, days into escrow and be able to move on whatever your plans are. This is a comparison of demand versus our inventory, and demand, this would actually be higher. Okay, you can already see that there's a disparity. So we definitely have higher demand than we have inventory. Now, also consider that typically sellers then become buyers. If we had more sellers willing to put their homes on the market, then these numbers would go up as well, because sellers typically become buyers of that next property unless they're truly getting out of real estate, and the majority don't. The majority are going to be buyers of the next property. So we can see that we're out of sync. We can see that we have higher buyer demand, and it's supply and demand, our good economic model. And we know that when demand exceeds the supply, then that pushes the prices up. Our luxury inventory. So this is a really, just to kind of put it in a nutshell, we have a lot of properties that are worth a lot of money. We have properties on the market, and we'll look at them when we see the cities that are in these higher price points. Now, obviously, because we have more of these properties as opposed to maybe, for want of a better term, more reasonably priced properties, these do tend to stay on the market a little longer. There was a time a couple of years ago, towards the end of COVID, where luxury properties were flying off the shelf, not quite the same speed. That market doesn't have that same velocity anymore. So those properties are tempering a little bit, but understand that we have so many of these properties that are now over 2 million that it really looks like things are stagnating on the market, but the buyer pool is a lot smaller. And they are still selling. It just takes a little longer for our luxury properties to sell. So our expected market time year over year. So we are sitting more in that, in that balanced market for our luxury properties. And so that feels like, when you see those for sale signs on the luxury properties and you see those for sale signs staying outside a little longer, you are observing the trend, and it comes down to the smaller buyer pool. However, if there is a motivated buyer, they are not as influenced by the interest rates. They have alternative means for financing, or they're okay with weathering the cycles of interest rates, which kind of go through, and we know we're a little higher than where we would want to be. And those with crystal balls that are a lot clearer than, and they have the clarity to be able to say they are expecting that come spring 2024, so first quarter, second quarter next year, we should see interest rates coming down a little more now that the Fed data is looking a little more what the Feds were hoping for as far as CPI, et cetera, et cetera. So again, as we mentioned, when the mortgage interest rates come down, we will see a climb in demand because there will be more buyers who will be able to afford the properties, and it's going to encourage sellers who know they want to replace, or they will need to replace their interest rate. So they may have a 3% interest rate right now. When mortgage rates come down and the knowledge of that new interest rate that they're going to have to take on is a little more palatable, we will see more sellers entering the market. But all of this just basically keeps us in a seller's market, keeps our prices up. So specifically looking at our 4 cities, Dana Point, slight seller's market, our median list price. So again, we're looking at what is on the market currently and where are we? Are we in that like upper luxury? And I'm not even talking about the 5 million, 10 million, or the $18 million property that I saw last week. We're just looking at, what do we have out there? Median list price, almost 3.5 million. New listings coming on are just over the 2 million. Our median days on market, 49. So even though we've got those higher price properties that are there, we're still seeing that those properties are going into escrow within about 49 days. That means that the buyers are there. So don't look at that California or the Southern California averages. Really look at each city to determine what that buyer demand is and how fast you might be able to sell your property. Our inventory, 48 homes, and it's declining, which means the properties that are coming onto the market are selling. As a result, seller's market. Laguna Beach, median list price, almost 5.5 million. New listings coming on, almost 3.3 million. Median days on market, 70. So this is where we're starting to see that it's a slight seller's market, maybe getting into a more balanced market in Laguna Beach. Even though Southern California, for these higher price properties, it's more of a balanced market. It is not that case in Laguna Beach. Inventory 109. There's a slight uptick in the number of properties that are on the market right now. San Clemente, median list price, 2.2 million. New properties coming on are closer to the 1.7. 49 days on market. It's a hot seller's market again in San Clemente, and we have 87 homes on the market, a slight uptick. But again, higher price point means that the buyer pool is a little more reduced. But 49 days, that's pretty good. If you have a desire or a need to sell your home, know that it's going to go into escrow pretty soon if it's priced correctly. San Juan Capistrano, median list price of almost 2.7. New ones coming on are actually a little higher than that. Median days on market, 42, still our hottest market. And we have 43 homes on the market, and it looks like we have a little uptick. But again, you're looking at properties over 2 million, that the Southern California average is a lot higher than what we're seeing along our coastal areas, and those prices are going up. So are we still in a seller's market? If you are in our coastal communities or close by, then absolutely we are still in a seller's market, even if your property is priced 2 million or higher. If you have a much higher price property, so the $18 million property, reach out. I can definitely run numbers for you based on your price bands and let you know where that buyer demand is and what we're seeing as far as that activity is concerned. And if you are not within the 4 cities that we cover, we do cover the market stats for a lot more cities in our weekly newsletter. Just drop a comment in and let us know. We'll get you added into our newsletter and keep you up to date, because again, our goal is to keep you updated on what is happening with supply and demand, how it's influencing potentially the largest asset that you own. And that's all about us being real estate planners and helping you to build protect and transfer that wealth through real estate. We have lots of tools in our tool belt to help you. And this is our contact information. And we look forward to hearing from you soon. And we'll be back next week with an update. Thank you.